Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us at the Market Site studio, we have Caleb Silver, Editor-in-Chief at Investopedia for Financial Literacy Month, which of course is every April. And for this segment, we're going to talk about investing rules to live by. And Caleb, we want to invest throughout our life, but we also want to make sure we're cognizant of what point in our life we're at.
Absolutely. It is a lifelong journey investing, but starting early and starting with the right habits is super important. So when you're younger, when you start investing, you want to be invested in growth. You want to be invested, take a little bit more risk and invest in stocks, because stocks have that long-term growth prospect that you really can't get with other asset classes right now. So build positions in either individual stocks, mutual funds, index funds, or ETFs. These are exchange-traded funds that are really focused on long-term growth. Select the stocks, if you're picking stocks, with good balance sheets, healthy companies, not companies that are just popular because of manias, but because their balance sheets are healthy, they're profitable, they have a path to future profitability. Diversify when you do that as well. So don't just buy one sector or one stock. Buy a bunch of them so you make sure you're diversified. You don't want all your eggs in one basket. And if you're a young person and you have a job and a 401k and your company's willing to match it, take advantage of that match. That's free money. And start doing this early and get into those good habits, because investing is one of those things. If you get in good habits at a young age and keep adding to your portfolio, when you're about 40, 50 years old, you'll be very happy you did it.
Well, let's start with the young ones here. If you're 20 to 30, how should you be invested?
Yeah, you want to be aggressive. You want to be invested in growth. You want to be invested in stocks and ETFs that have good long-term prospects. You want to be invested in the areas where you believe there's going to be growth in the economy going forward out several decades at least. So pay attention to those sectors. And again, if you're getting that 401k and your company will match it, take that match. If you're not getting it, if nobody's matching it, and you want to build your own Roth IRA or your own IRA, make sure you're being consistent about it, but make sure you're buying and buying often.
All right, let's talk about investing in your 40s to 50s. You're in the core of your career. You're thinking about sending kids to school, working really hard in your 40s and 50s. How should you be invested?
That's right. There's a little offense defense you got to play in your 40s and 50s. That means stay invested in stocks, stay invested in the growth areas of the market, but have some defense. And that defense comes from fixed income. It comes from bonds. It comes from cash too, CDs and money market funds. But also you can, if you're starting to accumulate some wealth, think outside of those asset classes to things like real estate, alternatives like that, that could be better, good growth prospects going forward in the long run, because real estate is a very powerful one if you're able to buy low and sell high. So you can diversify your assets and also rebalance a lot. It's not just buy and forget it. You've got to make sure your portfolio is balanced. You've got to make sure you're invested right with the right risk parameters for that age, that key age, 40 to 50.
And as we think about retirement income, how should you be investing in your 60s, 70s, and beyond?
Yeah, a little bit more defense there. You don't want to ignore the stock market, but you can't afford to lose a lot if you've come that far and built a sizable portfolio. So that's a little bit more defensive, more bonds, maybe more money market funds, maybe more CDs, since you're getting that money out of the bank these days. Don't ignore stocks completely. Just remember, you want to be able to handle a downdraft in the stock market if there is one, but you also want to have enough money on hand so that you can draw down that 4% or whatever you need to cost, whatever the cost is to be you. You want to make sure you can afford that every single month, and also know the tax implications of what you're doing, because a lot of folks forget your gains from stocks, if you sell them, are taxable depending on how long you've held them.
I like that. What does it cost to be you? It's a great way to put it. All right, Caleb, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.